In this video then I'm going to talk about intercompany loans, and I'm going to explain how you can loan surplus funds from one of your trading businesses to your property investment business in order to purchase more property. I'm going to start off by explaining what an intercompany loan is by using a case study. I'm then going to talk about some of the advantages and disadvantages and key risks of using intercompany loans. I'm going to finish off then with showing you a demonstration in Xero as to how you can process transactions for your intercompany loan. Okay, so firstly then, what is an intercompany loan? It's a loan from two related companies. So a very simple case study then. Say you're a entrepreneur, you have firstly company A, which is a trading business conducting an activity such as an accounting business or a letting agent, for example. You've got built up retained earnings within that company. Your options are you could look to pay out as dividends and then potentially use that to purchase property that way. But the problem with that is you're going to have to pay some personal tax in order to do that. So actually it's going to be quite expensive to get money out of this company into your own name so you can then use that for investment purposes. So an alternative would be, okay, rather than paying personal tax to pull money out of company A, is to set up company B, which is a property investment company, and then loan money directly from company A to company B in order to purchase property. Okay, some of the advantages of this then. Okay, firstly I've talked about the fact that the entrepreneur isn't going to have to pay personal tax to extract money out of their trading business into their own name to then invest accordingly. So that's a huge potential tax saving. The next advantage is that it's going to be quick and it can be actually nearly instant. So company A's got surplus funds, it can transfer the money to company B almost instantaneously, and that money then can be available within company B to purchase property. Compare that with using commercial finance to get money into your property investment company. The lead times can be a lot more significant than instantaneously, clearly. There's going to be a lot less bureaucracy to lend money from A to B than if you to get a commercial loan into company B, and also the interest rate can potentially be zero. So rather than having to pay high rates of commercial finance to get money into company B, you can lend money interest free into company B. You do have the option to charge interest if you wish to, but actually there's no requirement to do so. So actually from a tax perspective, it's tax neutral anyway, so there's no requirement to charge interest. There also isn't a requirement to set up a formal agreement between the two companies, although it may be advantageous to do so, just so everything is clearly documented. We come on now to some of the disadvantages then. Okay, the first disadvantage is it's going to create a level of complexity between your two companies. So A is going to have to be required to report on its balance sheet an asset which is company owned by company B, and likewise company B is going to have to report a liability or amount of money which it owes to company A. Depending on what reporting structure you use for your accounts, there may be a requirement to make a disclosure of this loan as well. You can speak to your accountant for more information on this. Okay, another second disadvantage then is if you're in the space of using the money you received from A into B, if B is then going to look to get mortgage finance to buy investment property, you may find that lenders have differing views on whether they want to accept an intercompany loan from A to B to use as deposits. So make sure you speak with your mortgage lender. From personal experience, I've found that with some cases, some lenders have wished for there to be a formal agreement in place and for B to be paying a interest. However, I have used this technique personally myself and I haven't had any issues with arranging finance. So I don't think it's too much to be concerned with, but make sure you speak with your mortgage broker for more information. I'm going to finish off with the key disadvantage or risk of using intercompany loans to fund your property purchases. So assuming that all is going well in company A, it's churning out profits, it's got a surplus of cash and it's lending to company B to buy property. As long as that continues, there isn't an issue. The real risk comes if company A goes into financial difficulty. So assuming company A, let's say it's a letting agent, comes under financial difficulty and actually becomes insolvent. what's going to happen then is going to go through a process of having insolvency practitioners appointed to deal with the issues in Company A, which is unable to pay its debts and liabilities. Those insolvency practitioners are going to look to the intercompany loan that connects these two companies, and they're going to pursue that loan to be repaid. So that means that even though they're two separate companies, because A has gone into difficulty and it has a loan into B, B is going to be required to repay that loan. So that could mean that you have a very short time horizon to liquidate assets in Company B and then pay them back to A. Okay, so that's something you really need to be aware of, that basically the two companies are even more tied because of the loan. It means that if A goes into difficulty, then B is going to have to repay that loan, and it might not have much time to do that, which could mean B has to liquidate the assets in a short time horizon. Okay, a couple of ways you can get around this then. I think the first one, this is something that I do personally. I have an accounting business and a property business. I very much treat the loan from my accounting business to my property business as on a short-term horizon. I very much use it much like a bridging lender would lend to a property investment company on a 12-month project or less. I'm basically looking to lend that money to the investment company under the understanding that it's paid back within a reasonably short time horizon. That's going to negate some of the risk of then having to liquidate assets if there was any kind of issue with Company A, which in my case, which is highly unlikely, but just you never know in business what can happen next. Okay, another thing you can look to do is you can actually, if you build up a significant loan over time, you can look to write off the loan between Company A and Company B, and this can be there's no requirement to pay tax on this if it's done correctly. However, you're not going to be in a position to do this if Company A has become into financial difficulty. This is very much something to do when everything is going well rather than when something has gone wrong. Okay, the final get around then is you consider that rather than having intercompany loans, to actually set up a group structure. So rather than Company A lending money to Company B, profits in A are actually paid up as dividends into a holding company, and then that money can then be redistributed around the group into Company B, and that's going to protect those funds much more than would an intercompany loan. I'll look to do another video in the future talking about group structures, which can provide more information. Okay, so what I'm going to finish off now is just the mechanics of how Company A can loan money to Company B, and what I'm going to do is I'll give you a demonstration in Xero as well to show you how you can account for it as such. Once A decides to pay money to B then as a loan, I talked about there's no requirement to put a formal agreement in place, but it might be something you want to consider just to formalise everything. But essentially all that needs to happen is Company A needs to then conduct a bank transfer to Company B, and then you need to process it accordingly in your accounting software, and your accountant will need to process it in your end of year accounts for both companies. So what I'm going to do now is I'm going to show you a demonstration in Xero as to how you can process these transactions and account for the loan accordingly. First thing I'm going to do then is we're going to set up both companies to process the intercompany loan. So we're going to start off with the lender company. So this is Company A, which is going to lend money to Company B, which is a property investment company. So this is Company A is our trading business. So the first thing we're going to do then is we're going to set up the relevant chart of accounts. So we're going to go into accounting and then chart of accounts. Because this Company A is lending money to Company B, Company B will then owe money back to Company A. This is classed as an asset on the balance sheet. So we're going to need to set up a new asset code. So we're going to click into assets. We're going to identify a code which is free and then click add account. We're going to call it just something really easy to remember. So loan to B Limited, and the description we can say intercompany loan, and we give it a unique code. I'm going to call it class it as a current asset. So current asset means that it's due due to pay back within the next 12 months, which in theory this could be maybe it goes on beyond 12 months. We could also make it a non-current asset as well if we thought it was going to be for longer than 12 months. Okay, so once we're happy, then we're going to click Save and just scroll down to the bottom. We can see that accounting code has been set up. So the next thing to do then is to process some transactions. We're going to click Home. Okay, so once Company A has set up its relevant chart of accounts for the loan, it can then simply transfer the required money from Company A's bank account to Company B's bank account. Make sure when you're doing this, you just clearly label the transfer as intercompany loan or something similar so you can remember what it is. And then you're going to need to process the transactions from Company A's perspective. So we're going to do that now, and I've put 2 transactions in here, which we'll see in a second. Just keep it nice and simple. I've said that on the 1st of August 2025, Company A has lent £100,000 to Company B, and on the 2nd of September, that loan has partially been repaid, or there'll still be a £50,000 outstanding. In reality, will it be paid back in such a short amount of time? Probably not, but it's just to give you an idea of how the transactions are going to look. So what we're going to do now is process those transactions from Company A's perspective. So we're going to copy and paste across the contact, and we'll need to set up a new contact for that, Company B. And then we're going to use the accounting code which we set up just before. And then let's add a description, company loan, and then click OK. And what we'll do is we'll process the second transaction as well. It's got B Limited, again, the intercompany loan accounting code, and we'll put repayment of intercompany ICO, intercompany loan, and then click OK. Okay, so what we can do now is just flip over to the balance sheet and just check that's worked. So accounting, wrong reporting, going to click today's date. And yeah, we can see under current assets, we have loan to be limited, £50,000. We click into that, we can just see the transaction. You can see the 2 transactions there. The first was lending £100,000 to Company B, and the second one was partial repayment. Okay, so from Company A's perspective, everything is in hand. So what we'll do now is we'll just we'll do the same from Company B's perspective. So now we're going to do the same for Company B. So this is the property investment company. We're going to do the relevant action required in Company B to set up for the intercompany loan. So again, going back to accounting, chart of accounts. So this time it's going to be a liability. So Company B is going to owe back the loan from Company A. So it's counted as a liability. I'm going to find a free accounting code. Got 910 is already one we can use, but you can use a different one for yours. I'm going to call it loan from A Limited. And then I'm going to click Save. We're going to call this a current liability. Click Save. And then so because Company A would have transferred money over to us, we can reconcile that transaction. And we're also going to say in this case, we've also partially repaid the loan again. So we've paid back £50,000. That would be a case of Company B sending a bank transfer to Company A for that amount. So we're going to reconcile the transactions now. You can see here then we've received a company loan, an intercompany loan from A Limited. So we'll just process that transaction. There, I've got a loan from A Limited. Again, we can put intercompany loan. Process. And again, with the partial repayment, then we're going to do the same for that. And again, if we go onto the balance sheet, we can just check that's worked. So reporting, click on today's date. And we can see there's £50,000 which shows as a creditor, so £50,000 owed to A Limited. So happy days, the transactions have all been processed, and that's how you keep a track of your intercompany loans. So you're just making sure you're doing bank transfers between the two, which are then associated with either the relevant asset in company A or the relevant liability in company B. Okay, hope you found this video useful. Just remember that intercompany loans can be a really powerful way to move surplus funds from a trading business into an investment company in order to buy more property. It is not without risks though, particularly if the trading business becomes into financial difficulty. That can then jeopardize any assets which are being purchased using the loan. If you are considering this, make sure you and make sure you document everything correctly, particularly when you're transferring money from A to B.